Let's start with the latest US core PCE inflation data, which has remained unchanged, which is slightly below the market expectation of 2.6%. Now, we'll talk about yesterday's GDP result in a minute, but that PCE number is important, isn't it? Because we've got the interest rate decision coming up in a few weeks' time, and if it had been above market expectations, that may have been a concern for those waiting for that rate cut. But the number is encouraging.
It is, Johnny, and I think that as we do this, obviously every week for the podcast, we discuss all the numbers that we can. We've watched in the last few weeks, it seems, inflation statistics really take a back seat to some of the other ones. I mean, even a few months ago, inflation readings, PCE, CPI, I mean, it was like everybody, it was so silent in the room as the number dropped. Everybody was so trying to anticipate what's going to happen, what is this going to do to the Fed expectations. And, while inflation is still very important, we heard from Jerome Powell himself, just the lean has shifted more towards focusing on the labor data. We're no longer at that 9% inflation year over year that we saw, which really spooked the markets. We've really come down a long ways. And so I think you've set it up nicely there with basically inflation now is just let's watch this number, and as long as it's not a threatening number, okay, then it's a non-event. It's almost like inflation are just like checkpoints that we have to, like hurdles that we have to get over, but they're not going to, make ginormous strides in the market. Because again, what is now moving the needle big time is more on the economic data side, on the like the labor side, right? How is the labor market looking? So we've seen that shift. Today's PCE number, I guess, ticks the box for not threatening. We didn't see a punishment for hotter than expected PCE numbers. We didn't see inflation ticking higher, and so the market kind of shrugged it off. They said, okay, well, that's a check mark. The dollar index is just modestly higher here today against other currencies, and for the most part, we saw sort of a muted Friday response to the PCE number. But again, I can't help but think a couple months ago, this would have caused a lot bigger market movements as everybody was so, waiting so patiently to see what inflation would do next. I think really, we are going to talk about next week in just a moment. We're going to get some jobs data next week. But we also, I think you mentioned we're going to talk GDP numbers, right?
That's right, because yesterday we saw the US economy growing at a slightly stronger pace in the second quarter than initially reported. And that certainly reflected an upward revision to consumer spending that more than offset weaker activity in other categories. I suppose the market was worried to a certain extent ahead of the US core PCE number, because they thought, well, has that put pay to a 50 basis point cut in September, and maybe we're going to revert to 25. So we're getting mixed messages. It's probably about even at the moment, but if I was to hazard a guess, I would say that we're going to look at a quarter point cut in September rather than a half point. Would you agree?
I would agree, Johnny, because here's the thing. Actually, this week, the GDP number that came out, the preliminary GDP numbers, for me personally, were the most important numbers to look at. I know everybody has their kind of, waiting on different things, but GDP numbers this week were very important to me, barring the NVIDIA earnings. That I guess was number one interest. But number two for me were the GDP numbers, because as we get closer, we've shifted, as I mentioned at the top of this podcast, on focusing more on the economy, the labor data, etc. But as you've just alluded to, it's also about what kind of cut are we getting in September? Are we getting the 25 basis point cut or the 50 basis point cut? Because there's some predispositions that come with each one. If you get 50 basis point cuts, there is going to be a camp of people who quickly get concerned that the Fed is behind the mark, behind the curve on this slowdown. But I actually think that if the Fed can do a 25 basis point cut, meaning they don't feel like they're behind and they're at a safe enough place, I think the ultimate signal that they could pull is just, let's do 25 basis points, signal that we don't believe we're behind the curve, that the economy's hanging in there, the consumer's not falling off a cliff, and things are just, overall fine, and things are kind of going according to plan. A 25 basis point cut would be more of a signal of optimism and strength in my view. And, that GDP number that you just mentioned helps us with that. It helps us to see, there's still growth in this economy. And if the Fed comes in on September, the September meeting and says, we're going to cut by 25 basis points because, there is still a relatively stable economy here that could reaccelerate in inflation. It is not something they want to reintroduce. If the economy is hanging in there, they don't want to, make borrowing costs too easy and get the market too optimistic that they start actually reaccelerating inflation. So with the good GDP numbers, I'll take that as good news. I think good news is good news right now because the economy the market wants to see it not rocky. If you enjoyed this video from the Market Insights Market Pulse podcast, you can listen to the full episode by clicking the link down below in the description. You can find us on your favorite podcasting apps, and again, we post several times a week, so if you're looking for market updates throughout the week, this is the place to be. Whether you're in the car on the way to work or something like that, make sure to tune in to get the latest. Thank you very much for watching. We'll see you on the next one.